Let's touch base with Madhu Kela, Chief Investment Strategist at Reliance Capital, one of the most followed voices on the Lal Street, for his perspective on how the road ahead looks for the markets. Madhu, great to have you in the show. Now, after a decade-long wait, the deadlock on GST has been broken. Historic moment, of course, but the markets have been exuberant for a while. Tell us, I mean, is all the news with regards to GST in the price, or is there still more headroom because we're at 8,700 for the Nifty now?
I would say it's a historic moment. I'd say this is something which we all have been eagerly awaiting. It is a real cause for exuberance for India. That much I would say, because something which has taken a decade being discussed, debated for so long, have been through two governments. I'm sure this is a very great legislation, and it will go a long way for the economy as well as for the markets.
Madhu, do you view, good afternoon of course, do you view this as a significant PE trigger as well? I mean, do we come at par with economies which have a better PE level or PE multiple than us?
Apart from the numbers, see what it does is it actually increases the efficiency of the whole system. That you had so many taxes, duty drawback, there was so much corruption which was arising because of so many taxes at so many state levels. So it is more about ease of doing business, it is more about one uniform, it is more about the efficiency of the overall sector, it is more about now people being able to plan their investments of what you are wanting to invest, because now goods and services will be freely transactable across states. So I think more than just the numbers, it is about that entire package which comes along with this passage of the bill.
Right. This is a major shot in the arm for India and, of course, for the economy at large, also for India Inc. How long do you think it will take for us to see the benefits coming through at every level?
So I think, the starting date could be, let's say, 1st April 2017. I would put maybe 12-18 months for the whole process to get stabilized. Let us not, this is a countrywide thing. There are so many states which are involved. There are so many different sectors. There are so many different industries. There are so many different corporates which are involved. And, there has to be a GST card given to all the manufacturers and this, that. So I would say 12-18 months period for the teething trouble and for the stabilization, and post that only we should count on big benefits.
Okay, Madhu, how should investors capitalize from here on? I mean, a lot of people have missed the recent run-up in the markets. How can they capitalize upon that?
So I think again it's bottom-up thing. So maybe stocks would have run up to the GST, but as we said, there is maybe 6, 12 months, 18 months time frame for the benefits to actually occur, and the sectors, companies which are definite beneficiary of GST. If you get a correction because of some event like Brexit, let's say for instance, which has nothing to do with implementation of GST and its ability to produce profit for the companies over the longer period of time, so you must keep an eye on those stock specific names and and sector specific themes which you like, and you have to use that volatility to get into those sectors and companies.
What about primary market activity, which has been remarkable actually? Listing day pops have been pretty much the order of the day. Many small niche issuances are getting overwhelming response. Do you think that those valuations are a bit too extended for comfort?
It's again demand and supply, because the supply has been so little from the primary market, and some of these companies are unique. But I would say, some of them are definitely trading at uncomfortable valuation as far as investors like us are concerned. So we are not saying just because this issue is coming, so we have to buy it. We have to only buy it if we believe that the earnings will keep pace with the valuations of the company which is currently there, and we have the opportunity to make money. So it's not a random universal call that everything which is being offered in the primary market should be bought, or everything which is offered in the primary market should not be bought. But I am a bit concerned that some of these companies are definitely trading at very, very rich valuations, and in due course of time, if the earnings do not pick up in pace with how much valuation they are discounting. So there could be correction in some of them.
Okay, Madhu, the other question obviously that comes to mind, or the obvious question, is your preferred spaces at the current point of time.
I think I would say that, one thing which we continue to like is this whole overall consumption theme, because as you said, monsoons have been good. Last 2-3 years, monsoons were bad. The overall 7th pay commission impact is going to be felt in India over the next 2-3 years. And, the rising middle class population in their urge to spend money is clearly visible. So one broad thing which we continue to like, in which there are many sectors come, is the overall this consumption theme. The second thing is that wherever you find these neglected companies in which have not run up, where the fundamentals are definitely in favor in terms of valuation in absolute value term, I think there will be some select opportunities which are linked more to economy. What I'm meaning, for instance, let's say the real estate sector. Obviously it has been out of favor for many years. Some stocks have corrected 80-90% from the peak which they made. And is there a opportunity in the entire sector? The answer may not be no. But is there a stock specific opportunity in few companies? The answer may be yes. And I must say that you must take this with whoever advisor you have. You must consult before implementing this advice.
Yeah, that's a fair point. Madhu, are you more cautious in mid caps and small caps now? Time to be more prudent and perhaps book profits here while one can?
You have to be very selective. I'm using the word not selective, but you have to be very selective, because in some of these companies you can burn your fingers big time, And as you rightly pointed out, a lot of them have run. So you have to wait for your time, and wherever you see the important part is also wherever you see that the earnings have got discounted for the next 2-3 years and stocks are still looking expensive, then at times, you have to even sell with conviction, because the problem is that, in a rising market, if you sell something at 100 rupees and if it goes to 105 rupees next day, you become very nervous. But my experience of 25 years tells me that eventually you have to keep selling what you believe has run its course and it is priced to perfection for the next 2-3 years. And my experience is always, these companies would correct, even though they may run up in the short term, but you will do a prudent job by ensuring that you are booking profits wherever you are not convinced about valuation.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.